Donald Trump has hit out at the Fed's decision yesterday to leave rates unchanged. It comes after his repeated calls for lower rates in order to boost economic activity and spending, a move that, in the short term, would be welcomed by home buyers and stock markets alike. But Jerome Powell, the Fed chairman, has taken a more long-term approach and said that the Fed governors do not need to be in a hurry to adjust our policy stance. This raises a fundamental question. Why is central bank independence so important? And why are governments generally bad at managing monetary policy? Well, in short, central bank independence is essential if we are to shield monetary policy from short-term political pressures. Governments, driven by electoral cycles, often prioritize short-term economic growth, even at the expense of long-term stability. If politicians had direct control over interest rates, they would likely lower them to stimulate the economy before elections, boosting growth and employment in the short term, but risking inflation, asset bubbles, and economic instability in the long run. History is littered with examples of how politically controlled monetary policy has led to disastrous consequences. The most extreme cases lead to hyperinflation, where governments resorted to excessive money printing to finance spending, eroding the value of currency and destroying economic stability. However, there are countless examples of more mundane mismanagement that, while less spectacular, led to years of unfavorable boom-bust dynamics. One of the most notable examples of central bank independence's importance is the UK's experience before the Labour government granted the Bank of England autonomy in 1997. Prior to this, monetary policy was subject to political influence, with the Treasury often keeping interest rates too low for too long under pressure from policymakers. This led to inflation spikes and economic instability, as short-term political considerations outweighed long-term economic stability. Granting independence to the Bank of England was one of the Labour government's first major policy decisions, a move aimed at boosting credibility with financial markets. By insulating monetary policy from political interference, the government signalled a commitment to responsible economic management. This reassured investors, helped stabilise inflation expectations, and created a more predictable economic environment. The policy proved successful, reducing inflation volatility and mitigating the cycle of boom and bust that had plagued the UK economy for decades. Independence allowed monetary policy to be set with a long-term perspective, leading to greater economic stability and lower inflation in the years that followed. A more recent example of the dangers of political interference in monetary policy is Turkey under President Erdoğan. Erdoğan's insistence on lowering interest rates despite high inflation, based on his unorthodox economic beliefs, led to a currency collapse and spiralling inflation. His repeated firing of central bank governors who opposed his views only deepened the crisis, eroding investor confidence and triggering capital flight. Turkey's experience serves as a stark warning of what happens when central banks lose their independence. Fortunately, the Federal Reserve enjoys a high degree of institutional independence. While Trump has been vocal about his dissatisfaction with Fed Chair Jerome Powell, he does not have the power to fire him at will. Powell's term as chair runs until 2026, and any replacement would require Senate approval. Additionally, the structure of the Federal Open Market Committee helps insulate monetary policy from political pressure, as 5 of the 12 voting members come from the regional Federal Reserve banks, which operate independently of the executive branch. However, this does not mean the Fed is immune to political pressure. Trump is likely to apply maximum public and private pressure on all decision-makers at the Fed. His proposed tax cuts and tariffs are inherently inflationary, increasing the likelihood that the Fed will need to raise interest rates rather than cut them. If Fed officials cave to political pressure and lower rates prematurely, inflation could accelerate, leading to economic instability. Consequently, the independence of the Federal Reserve is a critical safeguard against short-term political pressures that could destabilize the economy. With Trump's policies likely to fuel inflationary pressures, the Fed governors must remain steadfast in their commitment to controlling inflation. The coming years will test the resilience of the institution, but history shows that when central banks surrender to political influence, the consequences are never good. I hope you enjoyed this video. If you did, then please like, subscribe, and comment. Thanks for watching.